program. To take this forward, we have Karan Taurani, who's the EVP at Elara Capital, joining in now. Karan, good afternoon. Thank you so much for joining in. Well, numbers are known. There's definitely a recovery that we're seeing. But do you think this will sustain, and would it get better with the consolidation that the industry is seeing?
Hi, good afternoon. I think 2-3 triggers to watch out here in this quarter. One, obviously, is the commentary for the month of Jan in terms of SSG being positive. Now, this is coming after a very long time. Almost about 6 to 8 quarters is when the tide is turning positive in terms of SSG. So obviously, sustenance of that is a key model. Second thing to watch out here is the margins, right? So I think most of these companies did see a positive impact in terms of their raw material prices coming down because of the GST cut, which happened around 3 months back. So I think this is also leading to improvement in gross margin after many quarters by anywhere in the range of 80 to 100 bips for many of the companies. And thirdly, I think the valuations for most of these companies had come up by almost 30-40% over the last 6 to 9 months, primarily because of growth being an issue structurally. So some respite on growth with an improvement in margin and a slightly better outlook with valuation supportive is leading to the momentum in the share prices.
Okay. But Karan, welcome to the show. What is your expectation in terms of the same-store sales growth? Do you think that this momentum can continue? What are you factoring in?
So I think in terms of SSG this year, given the 9-month performance and the Q4 outlook, most of the companies will still report a negative SSG. As far as the outlook for next year is concerned, FY27, we do see some kind of respite. But we don't see SSG numbers moving towards 3 to 5%, which has been the trend historically during the pre-COVID times or in the times where actually these businesses opened up in terms of pent-up demand, in terms of dining. So that has been a major problem area. If you look at most of the QSR companies, Devyani, Westlife, Sapphire, they derive almost about 45% of the revenues from delivery. So the delivery channel growth remains to be healthy in the range of 5 to 6% on SSG, but it's the dine-in which is causing the concern here. So these companies structurally cannot expand their delivery proposition more towards 50% plus over the medium term, wherein the likes of Jubilant are favorably placed here because their delivery contribution is over 70%. So from that standpoint, these companies will continue to report underperformance versus Jubilant as far as SSG is concerned. And margins, of course, I think will sustain for the next 2 or 3 quarters because you will keep seeing benefit of lower raw material costs.
So margins will sustain while Jubilant will be doing better in terms of SSSG versus other QSR is what you're saying, right?
Yes, absolutely.
Okay. Karan, what about Devyani Sapphire specifically? Mangalam was right now highlighting as well that turnaround in Pizza Hut is coming in. What is the growth trajectory over there and how would that add on to Devyani Sapphire then?
So if you look at Devyani Sapphire, firstly, in terms of merger, there are no material synergies as far as revenue is concerned. Most of the synergies will play out on the cost front, wherein incrementally you could see a positive impact of about 60 to 70 bips in terms of gross margin. And of course, valuations could kind of come at par because Sapphire is always traded at a discount as compared to Devyani in terms of valuation multiples. But given where the metrics are, that gap could also converge. In terms of Pizza Hut, I think what is happening in the pizza category is that you're seeing a cool-off in terms of competitive intensity. And that's one of the reasons in terms of why we like Jubilant FoodWorks. Because whatever you saw in terms of margin compression for Jubilant FoodWorks over the last 2.5 years, that is also largely behind us. Pizza Hut has seen a turnaround, but again, Pizza Hut, we don't see any strong growth in terms of store addition. Jubilant is the only one which could potentially grow the store count at 8 to 10% number, whereas Pizza Hut will be far lower in terms of store growth. So, another important point to note here is that for all these QSR companies, their margins have become almost half over the last 2 years. So if you look at something like a Westlife, their pre-Ind AS EBITDA margin was more towards mid-teens or high teens, which has now come to below 10%. So clearly, whatever they're getting right now in terms of a positive SSG, it is coming heavily at the cost of margins, which may not see a recovery, from a medium to long-term perspective.
So, Karan, quickly, so do you think somebody should look at these stocks currently, the run-up that we've seen, but there's still risks going forward, right? And quickly, if you can tell us on Trent as well, what did you make of that?
So on QSR names, one should definitely look at it from a tactical perspective, or like a Devyani, Westlifefoodworld, Sapphire still offer upside of 15-20%, not beyond that. But we still prefer Jubilant structurally because of higher delivery mix and lower competition in the pizza space. As far as Trent is concerned, again, some minor signs of recovery there, but it's majorly led by the portfolio of Westside. Westside has seen very strong growth in terms of store count, and that's led to overall revenue growth in a better manner. Margin surprises also come because of Westside, because Westside margins are far higher as compared to Zudio. But again, there are risks on that as well, because Zudio is a far more scalable model, and Zudio is the one which was actually growing very high in terms of LFL as well. So if Westside growth rate is not sustainable going ahead in the next 2 years, you could see negative surprises for Trent as well as far as revenue growth is concerned.
Okay, all right, Karan, we're going to leave it on that note. Thanks very much for that comprehensive take in terms of what's taking place in the QSR space, as well as Trent, which is in fact the top gainer on the Nifty today. There's been that margin improvement which has come in for Trent at around 20.2%, which has really enthused the street this time round.